Hello folks, this is Tony Drake from Drake & Associates with an educational economic update for January 2019. In this month's video, I'll discuss some of the major headlines that influenced markets in December. I'll also provide some insight into what these developments could mean for you as an investor. As always, please stay tuned at the end of this video for a required disclosure statement. Well, the big question is, how do we close out 2018? To put it bluntly, December was a challenging, volatile month for stocks as equities also ricocheted between losses and gains. Let's take a look at an illustration of how dramatic the turbulence was. Consider the Dow's performance on the days surrounding Christmas. First, the Dow experienced its worst Christmas Eve in history. Then the very next trading day, the index posted its largest point gain ever. That experience was pretty much December 2018 in a nutshell. In fact, despite positive returns on the year's final trading day, the Dow and the S&P 500 had their worst December results since 1931. All three major indices also had their worst annual returns in a decade. In 2018, the S&P 500 lost over 6%, the Dow was down over 5.5%, and the Nasdaq gave back nearly 4%. Just a few months ago, the indices were reaching new record highs. So why the about face? Well, many investors sold off stocks in reactions to worries about economic growth and the Federal Reserve's policies and ongoing trade tension. However, that answer could oversimplify the situation. Some people blame computer-generated trading for these intense fluctuations. Others said we were in a period of hypersensitivity to headlines. Of course, investors had many headlines to digest, including a government shutdown that was on its 10th day by New Year's Eve. But what we want to take a moment to look at is beyond the big headlines and see what the data told us in December. In the latest readings, we learned that personal income was up 4.2% over the same time in 2017. The manufacturing and services sector both beat expectations. The economy also grew at 3.4% annualized rate in the third quarter. That reading was slightly lower than the initial projections. But at the same time, only one quarter had faster growth in the past 4 years. That was the second quarter of 2018. In other words, several data points are showing that beneath the market gyrations, the economy is still strong. Federal Reserve Chairman Powell echoed these statements when announcing interest rate increases in December. More concerns might be here, though, as the markets might not like those increases. But the Fed's assessment is that our current circumstances indicate a very healthy economy. In the year ahead, we'll continue to monitor the market's real risks and opportunities. One thing that won't sway us, however, are those scary headlines. Now that's it for this month's Educational Economic Update. Please visit us at wealthwisconsin.com to learn about our upcoming workshops, and be sure to tune in to the Retirement Ready radio show on AM 620 WTMJ Saturdays at 1 o'clock. Once again, this is Tony Drake from Drake & Associates signing off for the month of January 2019. As always, please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call. We'd be happy to talk to you. Thanks.